And now for something completely different.
Forget everything you've been told by others before.
Your opinion on William Bernstein's quote, "Once you won, quit playing."
I am a firm believer in that.
Get ready for the real deal.
I quit playing years ago. When I got married, I won, I'm done. So.
The full story.
I think they're maybe alluding more towards
money,
market returns
yeah.
and money, but yeah.
The whole enchilada.
To remember that all these people were running around, they were going into the metaverse, and they were spending hundreds of thousands of dollars to buy real estate in the metaverse.
It's money, news, and information you can use to grow financially healthy, wealthy, and wise.
And Facebook bet on this heavily at the time. In fact, $80 billion worth of a bet. And they even changed the name of the company to Meta.
Now, welcome in The Real Deal, the real investment show with Lance Roberts.
As of yesterday, they are now shutting that down.
Oh, really?
Yes. So the metaverse will no longer be the metaverse.
I guess Meta doesn't matter.
I guess it don't matter no more, for sure.
Presented by RIA Advisors.
And good morning and welcome to the show. Today is, of course, the last trading day of the week. Tomorrow is, of course, a national holiday because July the 4th falls on Saturday, and it is your constitutional God-given right to have a day off. Amen, brother. Around July the 4th. So you will get Friday off tomorrow. Banks will be closed. Markets will be closed. Bond market closes early today. Stock market's open all day today, but the bond market will close early today at noon. So it'll be half a day of trading on the bond market. So volumes will be a bit light. But again, everybody's preparing, of course, for the 250th celebration of America's independence this weekend. I was talking to a guy yesterday from Canada. They had Canada Day yesterday. I saw that. Yes. So they had their Independence Day yesterday. I think from the War of 1862 or something. Somebody crossed and they sent them back home. It was very short, whatever it was. So anyway, so happy 4th of July to you this weekend. Enjoy yourself, but also be grateful for this great country that you live in, the land of opportunity, home with the brave. A couple of other things also on top of that. The U.S. national men's team. Won their game in the first knockout round. The U.S. team won. And it was interesting, because they lost their previous game. And there was a bunch of haters on social media saying, "Ha! So good that America lost their game." And it was like, did you realize that they played their second string team in that game because they already had it locked up to go to the first knockout round. And so they didn't care if they lost or not. They kept their good players, let them rest up for this match. But anyway, so we play, I think next Monday is against Belgium, and that'll be to move into the next round. So congratulations so far. We're doing well.
Belgium, huh?
Yeah, I believe they're next.
There will be no waffling.
You cannot waffle on the Belgians. That is
just saying.
This is true. Speaking of kind of irony, in 1993, if you have not seen this movie, there's a show on Netflix. And it's called Pepsi, Where's My Jet?
I've not seen that.
You've not seen that?
Oh, it's about that.
Yeah, so in 1993, John Leonard,
yes,
Pepsi came out with a loyalty point program and said, hey, if you save up 7 million points, you can buy a jet, a Harrier jet, right? Nonetheless, not just a jet, a Harrier jet.
You win a jet, don't you?
That's correct,
yes.
Right? You redeem the points. So Pepsi never thought anybody would take it seriously. But John Leonard did, and he went and raised enough money to buy the 7 million points and went to redeem the 7 million points for the Harrier jet. And Pepsi said, no, we're not giving you a Harrier jet. That wasn't a real price. It was all a joke. John Leonard takes him to court and loses in court because the court says, well, it was never a real expectation that you should actually get a Harrier jet. A civilian would have a Harrier jet. So he lost in court. Well, 30 years later, he's now in his 50s, he's got kids. Frontier Airlines has made good on this. There was a Super Bowl commercial about this as well, but they've actually now completed the whole transaction. Frontier Airlines filmed a commercial of them giving him the keys to an Airbus jet. Not really. They gave him 7 million miles in exchange for his 7 million points. He now has free flights for life on Frontier Airlines. Not that they go anywhere, but you get the point. Anyway, they've turned this into a very positive spin for Frontier Airlines. John Leonard finally gets redemption after 30 years. and probably even got a little bit better price. I mean, because honestly, with a Harrier jet, what are you going to do with it? And you got to maintain it and all that. So probably the free miles were a better gift. But congratulations to John Leonard on that. So always a little something. Anyway, all right.
Always read the fine print.
Yes. Well, it wasn't in the fine print.
That's the point.
That's the whole point. There wasn't in the fine print. They just said have a jet. They were joking, but there was nothing in there that said it was a joke.
Yeah.
So anyway,
There
that's
you
that.
go.
That. If you haven't watched it, it's actually pretty interesting. It's on Netflix. You can watch it. But anyway, John Leonard made whole just recently on that. All right, let's talk about what you need to know before the bell this morning. We'll get into the markets and interest rates and what's going on with that with Michael Lebowitz here in just a second. So. Yesterday, of course, we talked about the fact that the market broke above the 20-day moving average. Now, yesterday, the market actually opened down a little bit yesterday morning, bounced right off that 20-day moving average, and then turned back up, and we finished positive for the day. So, again, that's kind of what, this is as you want to see from a technical basis. You've had this reversal. You've broken above resistance levels. You've now tested that resistance level. Markets are pointing up this morning. The Dow's looking to be up about 200 points this morning. Nasdaq's a little bit flat because semiconductors are lagging. But as we talked about last week, in particular, we rotated from value to growth in our portfolio last week. And that value to growth rotation is really value to the mega cap growth stock. So our actual model uses VTV, which is the Vanguard Value Index, versus MGK, which is the mega cap ETF. So that rotation occurred last Wednesday. Since then, the mega cap stocks have been outperforming value by a decent margin, and we're going to see a little bit of that today. So semiconductors are going to drag the technology sector this morning. They are pointing lower here, at least at in the pre-market trading. But Microsoft, Amazon, Tesla, those stocks, Apple, are all in the green this morning. So again, we're going to see a little bit more of that potential rotation, but because of that weighting in the semiconductor stocks, which now make up 18% of market cap, that negative drag is going to drag on the NASDAQ this morning. But overall, we should, again, kind of see a relative decent performance day, and not fantastic to any great degree, but we should hold above that 20-day moving average. Again, we're very, very close to triggering a buy signal, so if we do get some positive action today out of the markets, we're likely going to trigger that buy signal. But again, I would be a little bit cautious here only because, again, nobody's going to be trading today for the most part, with tomorrow being closed. Nobody's going to want to potentially hold over the long weekend, so there's a potential for some volatility today. But kind of watch that 20-day moving average because, again, that's going to be kind of the key support level right now. If the markets can hold that, we're likely going to get a push higher next week, trying to push back towards these previous highs in the market, particularly as we start to gear up for earnings season, which we'll start getting some early kind of reports. We'll start getting into financials, and then the week after that, we'll get into some of the tech stocks. But that's going to start up next week as we get back after the holiday. Overall, outside of that, though, if just taking a look at interest rates as an example, we talked about this before as well, is that interest rates had a very nice move lower. Again, got very oversold here on a couple of measures and then have bounced here over the last few days. That's not surprising. The trend is still working itself lower in rates. But again, we're going to get some of this volatility. And as you're looking at kind of where we're starting to pull through inflationary pressures, expectations still remain fairly well anchored, but with oil prices declining, that's going to start to feed into inflation. So this potential move higher here is likely going to be fairly short-lived here as if we begin to start to see that kind of that inflationary pullback, or at least that oil impulse starting to come out of the inflation data, that should help keep interest rates fairly well contained. And as we'll talk a little bit more about today, there's been a bit of a negative correlation between stocks and interest rates as of late. We'll see if that starts to kind of re-correlate itself, particularly if we start getting into some market stress, kind of later this year. Again, after the month of July, we talked about August, September being a little bit more risky in terms of the midterm elections. And if we get a risk-off trade in the markets, will that negative correlation start to work into the advantage of the market itself in terms of being a hedge. So again, kind of watch that. But again, we've talked about potentially increasing some duration here as we start to see inflationary pressures pull back. It's going to take a while for those that kind of disinflationary pressure to work its way through, but increasing duration may be opportunistic here. Again, we need to see where this kind of push higher in rates ends. Does it kind of stop here at 4.5%, or can we get back up to the 4.6% range? But we're starting to get pretty well above inflationary expectations. And so that term premium is getting a little bit wide, and that should likely compress itself, over the next couple of months as we see those inflationary pressures subside a bit. We'll keep watching that, keep you updated, but that's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz, and kind of talk a little bit more about the bond market, interest rates, kind of this correlation between stocks and bonds. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
When there's rumors going round how the market's going down, who you gonna call?
Narrative Busters.
When you're worried about your dough in the market's ebb and flow, who you gonna call?
Narrative Busters.
Our next Candid Coffee pits Lance Roberts, Richard Rosso, and Danny Ratliff against all the false talk you're hearing these days, and how market narratives are created and spread, and why emotional investing can derail your financial goals. Saturday, July 18th, it's the Narrative Busters edition of Candid Coffee with Ratliff, Rosso, and Roberts. Register today at realinvestmentadvice.com.
When perspective's dim, don't invest on a whim. Who you gonna call?
Narrative Busters.
Candid Coffee, Saturday, July 18th. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning, of course, as we always do on Thursday. Michael Lebowitz joins us, talk a little bit about markets and kind of what's going on in the world. Mike, welcome to the show this morning. How are you?
I'm doing well.
Good.
How about Team USA?
I know, we're just talking about that. So
Looking good.
Next match is going to be difficult for a variety of reasons. So wish them the best of luck on Monday. So we'll see how they do.
Yep. Nice. By the way, Brent, nice joke on the waffles. Took me a little bit to catch up with you, but I got it.
Exactly. All right. Well, let's talk a little bit about markets. One of the things that's been, going on as late. We've had this again, as I was talking about during kind of the opening segment. Is we did this value to growth rotation last week. We saw that trigger between value stocks and the mega cap stocks, which is kind of the base model that we look at. And since then, Apple, Microsoft, those stocks have been doing well. We've seen some pressure in semiconductors. What are you thinking here?
It's a really interesting trade setup here because we switched from value to growth, and growth itself, if we're looking at the XLK or some other indicators, may not do that well, but our trade might do well purely because all those semiconductors and all the hardware stocks have been driving growth. The Magnificent Seven, those very large cap technology companies, like you mentioned earlier, have been greatly lagging. So we could have this market where growth itself doesn't do all that well versus value, but those Magnificent Seven kind of outperform the semiconductors and hardware stocks that are in desperate need of a break. They've just gone too far, too fast. So it's a very interesting setup. And I think a lot of it was accentuated by quarter end, which can have when you have a quarter like we just had with massive divergences between winners and losers, the quarter end and the post quarter end, so the couple days after quarter end, can create quite a bit of unrebalancing or rebalancing and then unrebalancing, which can have a pretty big impact on sectors, especially those that either outperform by a lot or underperform by a lot. So, I think this trade will be interesting, but the degree to which that some of those Magnificent Seven stocks are oversold is not necessarily at record levels, but pretty severe.
Yeah, and it's been interesting. The value index, when we first kind of put on that trade, was very extended, and it's actually pulled back decently just over the last couple of trading sessions. It was, when you looked at kind of our factor rotation model, it was kind of up there in some of the most overbought extremes, and now it's pulled back to about midway. So, I mean, it's not as overbought, nearly as overbought as it was. And that just happened just in a couple of very short days, because we saw some pretty big sell-offs in, the Pepsis, the Cokes, the Procter Gambles, those type of things. Of course, semiconductors, which are in that value index, Micron as an example, those have had pretty decent corrections here. So that's really kind of pulled that value index back a lot.
Right. That's what makes this trade a little tricky to look at, because Micron is considered a value stock. It has a very low PE, a very low PEG ratio. So I'm not arguing that it shouldn't be in there, but investors traditionally think about it as a technology stock, which they automatically assume is a growth stock.
Mm-hmm.
So that's what makes some of this trade a little non-conventional, so to speak. I really think once we get into more mid-July, we'll have a much better feel for how it's worked. We're 2-3 days into the trade. It's worked, but I think we'll have a much better idea on how it's working when we get to mid-July. And you get all this quarter end trading out of the way.
Right, and again, we also have a lot of other impacts. Just again, we got a holiday shortened trading week, so there's a lot of investors that are just kind of sitting on the sidelines right now until after this week is over. And again, because we see so much of the influence now in the markets. I was just posting a chart this morning. When you take a look at the amount of options that are being traded, in the overall market, like 40% of them are now just 0-day traded options. So, it's no longer that people are writing options, using options for longer term investment and hedging. It's strictly speculative bets on the outcome of what's going to happen today in the markets. Right. And that certainly has an influence on things like, semiconductor stocks. I'm betting that semiconductor stocks are going down today. So I'm going to buy 0-day to expiration option puts on semiconductors or, whatever. And that certainly has an impact on, those sectors, those stocks and that performance in particular.
And it works both ways. I think a lot of those options really helped those sectors over the last, month or so. And at some point they can come back and work the other way too. But look, Micron's fallen a decent amount, and it's barely at its 20-day moving average. So
yeah, the extensions were pretty ginormous.
Exactly. So we'll see. First of all, we'll just see if it can definitively break the 20-day moving average before we even think about the 50, 100.
Yeah,
you can't even think about the 200. It's so far away.
Right. No, exactly right. But that kind of brings up, kind of the other side of this, which is kind of hedging portfolio as well. And bonds have been negatively correlated to stocks here for a while. It's good. It hurts you when stocks are rising and bonds are falling in price. But, the reason that we own bonds obviously is for that hedge in case the markets do turn negatively, which is the potential. But again, what part of that, issue that's going on right now is we talked about last week, a little bit about, increasing duration of portfolios, but we should wait until there's a bit of a retracement because yields have gotten a bit ahead of themselves on the downside. Now yields have had a nice move up over the last week or so. That's put some pressure on the bond market. Stocks have been doing okay, so you've had a nice kind of negative correlation going on between the two. But kind of what are your expectations for rates with, Keven Warsh now? We've still got expectations of at least one or two rate hikes this year. But with Keven Warsh at the helm and oil prices dropping, kind of what are you thinking now?
Well, so let's talk about Warsh first. So he actually spoke yesterday. It's his first non-FOMC public speech. He was at a conference, I believe it was in Portugal. And he was, again, very stern about we're getting inflation down to 2% to the Fed's target. he was also basically he's putting an end to forward guidance. He said it multiple times that there will not be forward guidance. So he kind of came off a little hawkish, but then at the same time, he was talking about AI and some of the productivity gains that he's witnessed over the last 3 or 4 quarters. And he's very optimistic about that. And, like we've talked about, productivity has a disinflationary or deflationary aspect. So, I think he's kind of stuck between this transitory inflation due to higher oil and how oil impacts everything else. At the same time, he sees this train coming at him with productivity benefits that are disinflationary. So, I think he's a little worried about raising rates only to have to cut them shortly thereafter. So I think that's where he stands. Now, what's interesting on the bond side is that inflation expectations. So what I'm looking at is the 5-year break-even rate. That's not a survey. That's the difference between tips and nominal bonds. And that tells you the market's expectation, where money is being put, not where someone answers a survey, but actual money. And the 5-year inflation rate is now slightly below where it was before the Iran war started. At the same time, crude oil prices have fallen a good chunk of the way back. They're not back fully, but gasoline and jet fuel and some of the other distillates are still high. So, and you got a market that's pricing in now 2 Fed tightenings. So there's a lot of disconnects in the bond market. Why is this war premium still there? Price of crude is almost back to where it was. Inflation expectations are actually below where it was, but the market does expect 2 rate hikes. So there's a lot in the air right now. And similar to what I said earlier, there's a lot of rebalancing going on in bonds as well. Stocks greatly outperformed bonds in the last quarter. So some people had to sell stocks, buy bonds. And then yesterday, if you noticed on the open, bonds got hit pretty hard and they came back. They caught back decent chunk of their gains. That to me just reeked of quarter end, of trades that had to happen. It was July 1st. So people had bought bonds before. They wanted to get right back out of them July 1st. And then more of the natural buyers came in.
Well,
so,
and then also to you, like for instance, in bond ETFs, there were dividend distributions as well.
Right. So that affect the ETF prices, but we saw it in futures as well.
Yes. But that brings up another point. So today we have the June employment report. It's coming out a day early because tomorrow's a holiday. And as I posted out this morning, ADP, Mike made comments about this in our daily market commentary this morning, which is on the website. But also, the ADP report came out yesterday with 98,000 jobs, Mike?
I think it was right around 100.
Yeah. So, I mean, decently strong, but not booming. But I want to bring up this chart for you as well. This is Revelio Labs. They do a kind of their own measure of employment. So just they're kind of digging into the real-time data, et cetera, and they created their own kind of employment analysis. They're expecting about 258,000 jobs today. And don't dismiss. This is kind of like the Atlanta Fed GDP now, their guess at GDP growth. This is just their guess at employment. But they have a fairly decent correlation to the actual NFP report. So don't discount this kind of measure entirely. It's not, it's a decent kind of measure to look at if you're kind of looking for a guess at what the NFP is going to be. But the reason I bring this up is that if we have a really, really strong employment report, that really kind of just keeps the Fed in a box. Not, if you're not getting weakened, if the employment growth is strong, the economic data is doing okay. It's not fantastic, but it's doing okay. Then the Fed really can't justify cutting rates with a really strong employment report. But at the same time, with inflationary pressures coming down, they're not really pushed to hike rates either. So, kind of the data is kind of piling up to where the Fed's probably just going to stay pat this year for the most part. And I think, the odds of a rate hike are going to start to fall here as we get, a little bit later into the year. What do you think, Mike?
Yeah. The rationale for cutting rates before we got to Iran was that the employment market was weak. And you showed it in that graph, how we had a bunch of months that were negative or flat or slightly positive. We've seen improvement, right? ADP's running back at 100. It was 0. I think it even got below 0. So that's improved. We've seen the JOLTS, some of the JOLTS numbers improve. The number of job openings has improved, but some of the other data really hasn't. So we have I would definitely say the job market is improving, but it's still subpar. A number like 185, would you say 185 for that estimate?
285.
285.
Yeah.
I think the market will actually think the Fed's going to be more interested in hiking rates, because now you have inflation that's still running north of 3%, right? Closer to 4%. And you have, it's one number, so don't read too much into it, but 285 is very strong growth. That's about 100,000 more than are being added to the labor force. And the first time we've seen growth like that in a while.
Yeah. Now, again, this is an estimate. What BLS actually comes out with today is anybody's guess. So
Right. It could be anywhere from 0 to 300.
Exactly.
And it could be revised anywhere from 300 to 0.
Yeah, that is correct also.
In 6 months. And again, one report isn't that meaningful. You need to see a series of reports. And we have seen a series of reports, public and private, telling us there is some improvement.
Yep.
So,
well, the big thing is that, the employment number is one thing, but really what's important is wage growth. And what we're not seeing is real wages rise, and real wages continue to be under pressure. So again, just because employment's strong, they're going to look through to wages, and I've got a report coming out on this tomorrow on the website. So in the morning, if you go to realinvestmentadvice.com, we have an article coming out called Wages as an Inflation Tracker. There's a 72% correlation between wage growth and inflation. So, it's okay to have employment growth. And again, there's a whole variety of reasons we're having employment growth. I mean, obviously we're hiring people to build out data centers and all kinds of stuff. But if that doesn't translate into wage growth, that's gonna not provide that inflationary push that would cause the Fed to start needing to hike rates. They're not going to hike rates just because we have strong employment. They've got to see that start to pass through to actual wages and inflation. And right now, again, we're not seeing wages grow at this point.
No, that's a great point. So in the JOLTS report, the other interesting thing was that the quits rate is still at like one of the lowest levels in a long time, which that just tells you that people aren't quitting their jobs to go find a new higher paying job. Like, we saw a few years ago that was going on in mass. So it's telling you, I think, that what we keep hearing is that consumers generally are still retrenching. Walmart was down about 4% yesterday, because there was a report that they're kind of struggling a little bit. Sales are weaker than expected. Consumers are retrenching. That's at Walmart. That's not at a Neiman Marcus or a high-end store. So, this whole K-shaped economy is having all kinds of kind of strange impacts. But that lower K, I think those consumers are still struggling. That's weighing on the economy. The upper K, who can take advantage of the financial markets, who make a lot of money, are doing really well. And that can all skew this data. So, and I don't see that changing anytime soon. So that's just something, when you look at all this data, you really have to go through it, dice it, and slice and dice it, and try to figure out what's really going on.
Well, no, and this goes back to our value growth story as well. I mean, this is kind of the hard part about investing in the markets right now. Is like, okay, I want to be a value investor, but Walmart's not a value stock. We've gone through those fundamentals before. Procter & Gamble's really not a value stock. Costco's not a value stock. Micron's a value stock, but it's actually in a growth bucket, right? I mean, when you think about Micron and, it's up 800% from its previous levels, that's more of a growth stock than it is a value stock, but it's still classified as value stock. But that makes it hard on investors in terms of, trying to identify these factor rotations in the markets, what's value, what's growth, what's working, what's not working. And it's becoming much more difficult because of these kind of bifurcations in the market. Again, you take a look at Walmart. Yeah, their sales are a little bit slower. Who cares? They're the largest. They sell more stuff than just about anybody. But again, because it's so overvalued, it matters a lot in terms of the price because these small changes are now getting magnified within the overall markets.
Right, and this is the impact that passive investing is having. We just put titles on stocks. Right? Mm-hmm. Value stocks are obviously staples and utilities, though they must be value. It doesn't matter what their valuations are. They're value stocks because that's what we think of them. And growth stocks are technology stocks and some other stocks. And then because we're passive trading, you're either buying growth or buying value in the name of growth or value, even though that's not really what's happening. So it's become, if you're not paying close attention to this market, it can get very confusing. Like right now, again, we went from value to growth, and we, in a weird way, Lance, we actually went from growth to value,
right?
in what we hold, right? We sold some Walmart.
Yeah, we sold Walmart. We sold some Costco.
AEP, our utility. Coca-Cola,
yep,
and we bought Apple, Microsoft, Nvidia, and some of the other ones,
yeah,
right?
Palantir, and which has done well. And again, but that's the difficult trade in this market is just trying to sort some of these things out because the rotations are happening so quickly now. It's not like back in the late 90s and early 2000s when I was managing money, it was these rotations would take months and months and months to both form and mature. And now these things are happening in the course of a couple of months. And these rotations are becoming, much more. In fact, we launched the factor. It's a good example. We launched the factor rotation model in January of this year, January the 1st. And we've already done 2 rotations in that model since January. In the first 6 months, there's been 2 rotations in that model from value to growth and growth back to value. Or actually, value to, growth to value and value back to growth.
I think we've actually had 3, right?
No, just
1
2.
early on.
No, just 2 so far.
Okay.
Trust me, I get all the trade confirms in my account. That my accountant's going to have just a ball dealing with that portfolio this year. So, by the way, if you haven't been to SimpleVisor, these models that we talk about, we publish them on SimpleVisor, and we have 4 primary models on SimpleVisor that we produce on a regular basis. And here, I could just bring these up for you real quick. Wrenching show, just kind of capture the left side of the screen. But we have several different models. So we have our core portfolio models, which are the equity, the ETF, the dividend equity focused portfolio, and factor rotation portfolios. Those are actual live accounts that were funded and we're trading live on this platform. Below that, we have our thematic models, which are all the different kind of factor sector models. So international, crypto, small and mid cap stocks, infrastructure, growth focused equity. So those models are there for you. So if you log onto the website, your first 30 days are free. You can check out all the research that we talk about here on the show, but you can actually track and follow those models. And if you want, you can actually click the invest button and you can digitally open an account and we can actually manage the model for you. So as we make the changes to the portfolio, they automatically happen in your account. But that's on SimpleVisor.com. Again, your first 30 days are free if you want to check out all the research and stuff that we're using. And Mike, correct me, but around the July 24th, around there somewhere, we should be launching the new AI version.
The beta version. So we're going to have beta testers. We're not quite ready to release it to the public, but there will be a handful of people looking at it and helping us. But that's something we're working on. Our developers are working 24/7, and we're helping them daily make it even a better site. But Lance, going back to that, the website, even if you're not invested in those portfolios or even care about the portfolios, they provide great feedback on what the market is doing that day. Like it was very interesting that a lot of thematic portfolios, there are days where a lot of them are down, some of them are up, and you can read kind of what stocks are doing well, which ones aren't. Some of these value growth or other rotations that are going on. So there's a wealth of knowledge in there when you really learn kind of how to look at it and what you're looking for.
That's right. Yeah, I mean, and that was interesting yesterday because, like, you saw infrastructure under a lot of pressure yesterday. It was down that portfolio was down like 3% in a day, which is very unusual because this is companies like Masco and Caterpillar and boring companies involved in infrastructure.
Right.
But there was a big rotation out of that. But those have been kind of that value trade, and that's where a lot of those companies exist, because you think about a Caterpillar, it's like that's a value stock, right? But again, those were the ones taking the biggest hit yesterday, and you saw a lot of money rotating into kind of the growth side of the ledger. It was doing that a lot of those growth stocks, the Microsofts, the Apples, the Nvidias, the Palantirs, they did really, really well yesterday.
Right. The Mag 7 had their day in the sun after being
and it may be
month.
just a day, and we'll see. It may be all over tomorrow. We'll see what happens.
Right, and again, that's why we got to wait till mid-July, I think,
Yeah.
for the rebalancing to just clear out, and let's see how the trends are really going to assert themselves.
Yeah. Well, again, I think it too, just nobody wants to really hold this week anyway, just because of the holiday. The bond market's closing early today. That liquidity is going to dry up. And, so I think next week, once we start to kick off earnings, kind of the good thing has been with the mega caps. In fact, this weekend's article, I've been doing a bunch of research. So this weekend's newsletter, the Bull Bear Report, is going to be talking about the lag 7, right? Because if you take a look at all the indexes, the Mag 7 have been the lag 7 over the last couple of months in particular. And the question is now, is it time to buy them, or is that trade done with for a while? And so did a lot of research over this course of this week, been compiling a lot of data. And so I'll have that all analysis out this weekend. We'll talk about it next week. But again, it's that environment of the market that we're in. We're getting a lot of these narratives on different things, whether it's the narrative of CapEx spending or whatever it is. But at the end of the day, is that a lasting narrative, or is that just a narrative to justify why prices are going down at the moment? And is there opportunity being created to buy stuff at a much, buy some of these companies that have the majority of the revenue growth, the majority of the earnings growth, to buy these at much cheaper levels? And as investors, our goal is to try to buy things cheap when nobody wants them. And then when everybody decides that, oh yeah, well, maybe I should be in that, that's where we're going to capitalize on money. We don't make money chasing things that are at, massive deviations from long-term means. As we talked about yesterday, eventually you're going to have a reversion to the mean. And by the way, there was a really interesting comment I got after the show yesterday. Somebody emailed me and said that prices don't have to revert to the mean, because if prices just go sideways, the mean can catch up to the price. That's absolutely correct. That is also a mean reversion. It doesn't matter how you get to the mean, but as long as it reverts to that mean in some shape, form, or fashion, that's the better opportunity to invest. But here's the problem with that analysis, is that there is no case in history where stocks just go sideways for a period of time and allow the means to catch up. The reason they call it reversion to the means is that the vast majority of the time, I'm not going to say it never happens, but the vast majority of the time, stocks eventually correct in price back towards the mean. And that's why, as we talked about yesterday on the show, that's why paying attention to means is a very important part of, if you're looking to buy an investment, I really want to get into this stock or that stock. Is it extremely deviated from its mean on the upside? If it is, your opportunity for entry is not likely in your favor. If it's deeply deviated from its mean to the downside, your opportunity for entry is a lot more likely in your favor than not. So again, don't dismiss means just out of hand for whatever reason. They do play a very critical role in helping you judge your entry points into a position in your portfolio. Anyway, Mike, any comments on that?
No, but I saw earlier just in the chat that someone made a comment, something to the effect that if no one knew what the 20-day moving average was, would a stock would it bounce off or bounce off the 20-day moving average? And the answer is no, but it doesn't matter if it wasn't there. It's there, and everyone's watching it. And this kind of gets back to your mean reversion. Things do revert back to the mean, and the 20-day average is a mean. So would it bounce right on the number to the penny? Probably not. But would it potentially bounce around that area? There are reasons to say that it might and that it could, because what these moving averages help represent is where the buyers are buying, where sellers are selling. It helps quantify a lot of the psychological, behavioral, things that investors are sitting with when they're trying to figure out to take profits or not. So just piggybacking on that moving average reversion comment.
Yeah, no, and that's kind of the whole point. We had a bit of we were doing Q&A yesterday, and that was just one of the questions that came up. But real quick, we're starting to wrap up the show here. One of the things that has been paying attention to in the markets as of late. You and I think we've mentioned margin debt recently in some of our investment committee meetings that we've been having. I've got an article coming out, I think on Monday or next Friday on margin debt, and there's a lot of measures out there on margin debt that are not really good measures. The comparison to say, well, margin debt to GDP, margin debt to M2, those aren't really good, valid measures because you're comparing margin debt to a big macro indicator, and those really aren't related. I mean, margin debt doesn't have anything to do with government spending, or margin debt doesn't have anything to do with business investment into the markets. Margin debt is better measured by deviations from its long-term trend. It's better measured by the growth rate of margin. How fast is growth rate margin debt growing? And that gives you a certain indication about how aggressive investors are being. One of the things that is becoming more important to watch is financing costs for leverage. And this is what Mike and I have been talking about a lot lately, is that financing cost for leverage is going up. And that doesn't necessarily mean that it's going to cause a market crash tomorrow, but it's something to pay very close attention to, because as long as I can finance margin debt pretty cheap, then the rate of return that I'm getting out of the market can offset that cost of the margin, and those numbers work, right? But at some point, that cost becomes more prohibitive, and then margin debt starts to slow down. Well, that's the liquidity that's being pulled into the markets, right? So, as people take additional margin debt out, that provides buying power for the markets. Well, if they start to slow that rate of buying power from margin debt because of high financing costs, that potentially provides a headwind for the markets. And again, it doesn't mean the markets are going to crash or that, the markets are going to go down 50% tomorrow, but it does suggest that there could be a reduction in that buying power in the markets. Now, look, I'm not dismissing the dangers of margin debt by any stretch of the imagination. Margin debt is very beneficial to the bull market when it's going up, but it accelerates the downside in the market. If you decline enough in the market, you start triggering margin calls. It forces liquidation in the markets. And if you don't really have an example of that, go back and look at Liberation Day of 2025. The market declined nearly 20%. We were down a little like 19.5% in the course of like 3 weeks. That was margin liquidation. And if you take a look at that financing cost, those financing costs for margin collapsed in just a matter of a couple of weeks because there was an absolutely lack of demand for margin debt at that point. So again, it impairs you on the downside. It accelerates downside moves in markets, but it also benefits the bull market as long as it's intact. And right now, that margin debt is certainly supporting the market on the upside, but it's at least something worth paying attention to. Mike?
Yeah, Lance, and while you're on the topic, the yen is trading at a 40-year low. So there's a lot of this yen carry trade going on where they borrow in Japan. As long as the yen keeps depreciating, the financing is very cheap, and then they buy U.S. assets, primarily stocks and some bonds. So again, there too, it's all great that when the yen's depreciating, but when the BOJ, Bank of Japan, decides to either raise rates when the market's not expecting it, or to just intervene in the currency markets and cause the yen to spike, that can also pull back a lot of liquidity from the market. So bottom line is there's a lot of leverage being employed in this market, and those numbers can increase. and can add fire to this market. But at the same time, to your point, Lance, they can get pulled out pretty quickly.
And yeah, and again, doesn't mean I don't want anybody to walk away from this and say, Lance said margin debt's going to cause the market to crash. I'm not saying that.
Right.
Margin debt's very supportive for the markets when markets are going up because it provides liquidity, but it's something worth paying attention to. And it's not something that happens tomorrow. You need a catalyst of some sort, and when that catalyst shows up, that's when, that's when it becomes a little bit more problematic. Go ahead, Mike.
Right. It's just important to understand the environment that you're in and what risks can occur in that environment. Like most summer days, there are odds of a thunderstorm, right? Doesn't mean you're going to get a thunderstorm, but you should, if you're going out golfing, you should understand if that day, if the wind, whatever causes thunderstorms is going to happen. Same thing in the markets. We need to understand that we can have thunderstorms in this market. It's not a nice spring or fall day where thunderstorms don't really happen. So, but again, it can be another beautiful day like the last 30.
Yeah, and in fact, it's interesting that you brought that up because I just posted a tweet this morning on X talking about weather forecast accuracy. And this is something back in the, this is, Brent's over here chuckling. But pay attention to this chart because it's a very important chart. If you look at weather forecast, 97% accuracy over 1 day, 2 days, 3 days, 4 days. Up to day 5, they're about 90% accurate. The fall off rate for that prediction over the next 5 days to day 10 drops sharply and then continues to drop from there. The point about this graph, and the reason I posted it was this morning, is that back in the late 90s, Mike may remember this. He's old enough like me to remember this stuff. But in the late 90s, I think it was 98, 99, they did a survey of people that make forecasts. And they got to people like, psychics and fortune tellers and meteorologists and stockbrokers and Wall Street analysts. And they interviewed everybody that makes predictions. And then they calculated how accurate those predictions were. Meteorologists were the best predictors of the future by only 3 days. After 3 days, the rate of fall off is rather dramatic. Wall Street was at the bottom. Brokers were at the bottom. Fortune tellers were at the bottom. But the point about that, and the reason I posted this morning, is that this is part of that narrative conversation that we have here repeatedly on the show. In fact, we're going to do a whole narrative busting thing on July the 18th. Me, Mike, and Danny, and Richard are going to go through some of these big market stories and kind of break them down for you in terms of these narratives and how they work and what they mean. But the point is that when you're investing your money, when somebody comes to you and says, oh, the market's going to do X or Y over the next year or the next 2 years or whatever it is, invest today because in 2 years the market's going to be here. That might be the case. It's certainly possible, but any forecast more than about a week out really has no value because so many things can happen. I mean, just think about early this year. How many came into this year in January, and you can put one in the chat if you're the guy doing it. How many came into January of this year saying Trump invading Iran is going to be on my bingo card for this year, right? These things happen, and they come out of the blue, and they affect markets, and this is why we always talk about managing risk. We pay attention to these indicators like margin debt and other things that are going on. We pay attention to these factor rotations because things change in the markets. They can change very rapidly, and any prediction that's made, again, that's more than about a week out. And this is why when we take a look in the mornings when we do our daily market commentary, we're just looking at, hey, this is what the market did today. We're really oversold today. We're probably going to get a bounce here. That type of analysis, that's pretty easy to do. We can pretty much get 3 to 5 day movements out of the markets fairly good, but anything beyond that's just a sheer guess. So just be careful when people tell you stuff like, oh, the market's going to do this or this is going to do that. It can certainly happen, but by and large, most of the time, those forecasts are going to be wrong. And if you've bet a lot on some type of outlook by somebody, oh, the market's going to crash by, the reason I bring this up is here's a headline of a video that sits, because I've got my YouTube page up so I can watch your chat, but right below this is extraordinary divergence, why a market crash, extraordinary divergence, powerful stock indicator just gave an extreme crash warning. Maybe, right? Maybe that's possible. But most of the time, the Hindenburg omens and all these type of things, they typically don't mature into the crash. They may mature into a small correction or a pullback. Again, don't discount them entirely. Just make sure that you keep them within the context of managing the risk in your portfolio. Mike, I'll let you wrap things up.
It's all about the environment. Understand what environment you're in, and is it a very volatile environment or a very calming environment? And with that, then you can start proceeding to what kind of stock should I own? How do I manage risk? How do I think about risk? So think about the environment and don't let all these forecasts. You go on Twitter, you get bombarded with forecasts calling for S&P 10,000, S&P 500. They're all over the place. And someone will be right. That's just the way it works. But, just think about the environment that we're in and plan accordingly.
Yeah. And I'm not saying that these forecasts won't be they won't be right at some point, and they will. Just, but we have to just navigate till we get there.
And more importantly, have a happy July 4th.
Exactly. That's right. So markets are closed tomorrow. We will have a show for you tomorrow. So be sure and tune in the morning if you get up early like me and drink coffee on a Friday. But tune into the show tomorrow. Of course, we'll be back on Monday. And again, on Monday, we'll pick up with this kind of lag 7, mag 7 analysis. We'll get into that on Monday right here on the show. But it'll be in this weekend's newsletter. So again, if you want to read all about it first, be sure to get by the website, realinvestmentadvice.com. Subscribe to the newsletter. If you scroll just down the page just a little bit on realinvestmentadvice.com, you subscribe to our daily market commentary where we talk about the yen carry trade today. Get our weekly newsletter, which is out every week. And of course, our blogs that we post 3 times a week. You can subscribe to all those. We'll email them right to your inbox so you don't miss out on any of our latest research and commentary. And again, like and subscribe to the channel. It certainly helps us a lot. We really do appreciate your joining the show and being part of our family here on YouTube. So again, have a great day. We'll see y'all back here on Monday. Have a great, happy 4th of July.